Hey, let's talk about inflation and interest rates. If you watch the news or on any social media feed right now, it's probably been difficult not to see these two topics ad nauseum. So let's discuss why they are being discussed so much when it comes to the housing market. First off, I'm sure everyone watching this knows that inflation is overheated and pushing 40-year highs, and interest rates have certainly gone up since the artificially low rates we have all been accustomed to over the past decade. Well, they pretty much correlate with each other. One of the main reasons that interest rates have gone up is because of the high inflation. And the reason why is that inflation is considered to be the number one factor that will push up mortgage interest rates. Mortgages are pooled into bonds known as mortgage-backed securities. They are then sold to investors that receive income streams from those monthly payments each month. When the cost of goods goes up, payment streams are not worth as much, so to counteract this, higher interest rates are needed. In the beginning of March, we really started to see mortgage rates start to go up. Then, in the middle of June, we saw them at a higher level than we've seen in over 10 years. Why? Because the inflation numbers that came out that month were much higher than expected. Many so-called experts and the media were then claiming mortgage rates were going to continue to go up, and some predicted they'd be in the 8 to 9% range soon. Well, then the Federal Reserve then raised the Fed funds rate to 75 basis points that month, which was higher than expected. And guess what? This pushed mortgage rates down, and they've been trending down since then. The Fed does not directly impact mortgage rates, and I've talked about this on other videos, but they do influence them when they raise or lower their key rate, known as the overnight rate. This is the number one monetary policy tool they have to combat inflation. And when they did this, mortgage-backed securities responded in a favorable way. And just recently, the CPI report, the Consumer Price Index, which measures inflation, came in lower than expected, which has also been very favorable to mortgage rates. Look, we're currently trending in that 5 to 6% range. With a high credit score on certain products, we're close to being under 5% right now. And look, no one has a crystal ball, but if the inflation numbers continue to go down, likely mortgage rates will as well. Experts that I have followed and trusted for over a decade think we will see much lower rates at the end of the year and going into early next year. This could give the mortgage industry a much needed small refinance boom and give homeowners that missed out on those record low rates a chance to lower their payment. These artificially low rates that we've experienced were just that, artificial, because of a program called quantitative easing that the Fed initiated to help out the economy when we were in dire straits a couple times. Assuming they don't do this again, we will likely never see those low 3% or even under that range again. Even in today's rate averages, guys, we're still well under the 8.7% average that we've seen since 1971. So the bottom line is, don't let all of this noise prevent you from purchasing a home to live in. Marry that home, date the rate, they'll almost certainly go down, and when they do, you'll have a refinance opportunity to lower your payment into those low interest rates. Call us if you have any questions. Thanks a lot.